August Q&A with Cole and Associates. Here comes another opportunity to rub minds on various topical issues, ranging from ISA 220 in audit to understanding windfall tax in taxation, and IAS 7 cash flow in financial reporting, as well as the evolution of performance management in HR practice. I do believe that very many has gone through various content in the course of the month, and you have handful of questions insightful contribution you would like to make in the course of this presentation. Permit me to quickly introduce my colleagues who will be joining me in addressing various topical issues in the course of this of today's presentation. Let me start with the HR content. Matilda, are you there? Kindly introduce yourself, please.
Hi, good evening, sir. Good evening, everyone. My name is Matilda, and I'm going to be discussing about the evolution of performance management.
All right, thank you, Matilda. I have my other colleague who will be speaking on the audit contents. Is 220. Cousin, are you there?
Yes, I'm here, sir.
Yeah, can you introduce yourself for the audience to meet with you?
Okay, so my name is Olamilekun Kozim. I'll be speaking on quality management for an audit of financial statements.
Thank you very much, sir. Next to speaking on windfall taxation or windfall tax, my colleague Abiodun. Abiodun, are you there?
Yes, I'm just hi.
The audience would like to meet with you, please.
All right, thank you very much. Hi everyone, good evening. So today my name is Abiodun and we'll be discussing the matter relating to windfall taxes in Nigeria. Thank you.
Good to have you. And the last but not the least, the giant in the house, speaking on IAS 7, Alex. Everyone would like to meet with you.
Yeah, good evening, sir. Good evening, everyone. I'm Apioji Alexander, and I'll be taking you guys on statement of cash flow.
All right, thank you very much, everyone. And I do believe that everyone is well set to learning the process. Should there be anyone who is not here, but you feel should be here, please share the link with them or give them a call or send them a message of reminder so that they can join us as soon as possible. Alex, let me start with you. In the course of the month, we are written on IAS 7. IAS 7 being statement of cash flow. Would you like to enlighten the audience on the relevance of IAS 7 in financial reporting? Is Alex there?
Yeah, good evening, everyone. Hello, can you confirm if you can hear me?
Absolutely, we can hear you.
Yes. So, IAS 7 speaks to statement of cash flow, and we know how important the cash flow is to the financial statement. So, the cash flow represents it serves as a bridge between the income statement and the statement of financial position, right? So, and the standard that talks about that is the IAS 7. So, but before IAS 7, IAS 1 made it a very, very major requirement. It must form, that is, the statement of cash flow must form one of the minimum requirements for it to be presented on the statement of financial position, right? So, the objective, what does IAS 7 want to achieve? So, the objective of IAS 7 is to consider the historical changes in cash and cash equivalents, and it should be classified in between the operating, investing, and the financing activities. So what that means is that to shareholders or to investors, how the cash is being utilized in the business is expected to be grouped. Is it for operating activities? Is it for investing? Is it for financing? So by operating activities, it means that is the main revenue producing activities of the entity. So that's what it's, if it is that you are going to be spending your cash. If it is for operating activities, it should relate to the main revenue producing activities of the entity. And if it is for investing activities, then it has to do with the acquisition and disposal of long-term assets or other investments that may be considered as cash equivalent. Then for financing activities, they are activities that act as equity or capital or borrowing to build up the business. So before getting here, I made mention of cash and cash equivalents. Now, what are cash and cash equivalent? They are short-term, highly liquid investments that are readily convertible to known amounts of cash, and they are subject to insignificant risk or changes in value. And examples of this kind of cash equivalents are cash in hand, demand deposit, short-term investment. So for the presentation of a statement of cash flow, there are two methods that can be used to present your cash flow. We have the direct method and we have the indirect method. So what justifies the two approach is how you determine the operating net cash operating activities. For the direct approach, it centers on the receipt and payment to suppliers, employees, and other expenditures, interest expense, interest expense, interest income, income taxes that were paid before, then also the net working capital before you arrive at the net operating activities. Then for the direct, you start from your profit before income and tax, then you consider the non-cash items, then you consider your income. You consider your income tax, you consider net working capital before you then get your net cash operating activities. Then the summation of your operating plus your investing and your financing will either give you whether you have a cash surplus or a cash deficit. Okay. All right. So this is where we're stopping on IAS 7 cash.
All right, Alex, thank you very much. But much more intrinsically, there are certain terminologies that are peculiar with cash flow, right? Cash flow statement. For the benefit of our listeners, can you differentiate between cash inflow and cash outflow? What does it mean? So that our audience can understand that. Explain that in the light of what goes into the operating activities that you had earlier mentioned, what goes into the investing activities that you had earlier mentioned, and what goes into the financing activity that you had earlier mentioned.
Okay, thank you very, very much, sir. So starting from the financing, okay, cash inflows and cash outflows. So cash inflows represent income that you receive either as interest, could be as interest on a particular asset, could be as dividend, it can also be as could be as loan, could be as equity, it could be as equity. Then for the outflows, it could be as finance lease, settlement of debt, purchase and acquisition of assets. Those are what you may want to consider as cash outflow. So because it's cash inflow, if it's cash inflow you are looking at, so because it's cash inflow, it means that these are cash that you receive at hand, that you receive for the purpose of the business, cash, because IAS 7 strictly considers cash and not estimates nor provisions that profit or loss do consider, or statement of financial position do consider. So for the cash outflow, it represents every form of payment, every form of settlement that you are doing for the sake of your business. So if you then need to then categorize how these cash are used for either the operating, the investing, or the financing, you then need to consider, what is the purpose of this inflow or outflow for? So if the inflow or outflow are for the purpose of operating activities, such as for the trade receivables, changes in trade receivables, changes in trade payables, and income taxes that are being paid, then you may want to, and etc. You may want to consider that under the operating activities. But for the investing activities, items such as acquisition of PPE, disposal of assets, dividend on investment, you may want to consider that under the investing activities, because you have put your money to work either to acquire or to receive an income. So those are what you may consider under your investing activities. But if it is solely for expansion of business, and you can only expand your business either by equity or by debt, that you borrow funds, or you bring in your own capital into the business to expand business. So, or another item that you can also classify under the financing activities is lease. If you have to settle lease, probably finance lease, then you may classify such an item under the financing activities. All right. So that will be all, sir.
Yeah, so for the benefit of those who are just joining, we've just started with a discussion on statement of cash flow, that is IAS 7, and Harlet has made us to understand that this is a requirement of IAS 1, presentation of financial statements. Do not forget that everything we do as an accountant preparing financial statements, it is teleguided by the accounting standards. The accounting standards stipulate what we are expected to report on in every component of the financial statement. In the light of that, he has been able to identify 3 core segments of the statement of cash flow. He did identify the operating activity, which is the first segment, the investing activity, which is the second segment, the financing activity, which is the third segment. In his words, he affirmed that the operating activity strictly records the primary activities of the business. That is, identifying what is the company originally registered or incorporated to do it. Cash inflow that comes into the organization by reason of that activity, and cash expended by reason of that activity, are said to be reported under the operating activities. Under the investing activities, in his word, he also affirmed that under that section you record every form of capital acquisitions or investment in other entities. Therefore, in that segment too, you could have cash inflow, that is any activity under that section that brings in money, or cash outflow, anything that takes out money. Example of what takes out money in his words is purchase of assets, right? An example of what brings in money under the investing activity is disposal of assets. While under financing activity, these are various activities that provide funds for the organization. And that could be when you issue shares. In that instance, you are actually having a cash inflow. And when you redeem your loan notes, that could be a cash outflow. Alex, I'll come back to you with this. There is usually these two terminologies that sometimes when preparing cash flow is usually misconfused or misinterpreted. That is with respect to interest and dividend. You will agree with me that interest could be interest paid or interest received, and dividend could be dividend paid or dividend received. For the enlightenment of our audience, can you clearly explain which aspect or which of the activities each of these four items should appear, and is it an inflow or outflow? I take it again. Interest paid, interest received. How do you treat it when you are preparing cash flow? And statement of cash flow, I mean to say, then dividend paid and dividend received. How do you address that when preparing cash flow?
All right, thank you very much, sir. So for interest that is being paid, so before you can pay interest, it means somebody must have, or an investor must have invested in your business. So that is, the investor is entitled to a form of interest on whatever investment that he or she must have invested. So at that point, that interest that you are paying to the investor will qualify, can best be classified under the financing activities. But if it is that the interest is being earned, then the best place to classify such an interest is under the investing activity, because you have put your money to work, and as such you are investing. But the standard says that you can either put the interest earned or received, or dividend earned or paid under any category. But the purpose of a thing is the best direction of where to classify it, whether it is for investing or financing. The same explanation goes for dividend. All right, sir.
Address the aspect of tax paid.
Yes, income tax that are paid are usually paid as an operating activity, because you are paying taxes on your principal revenue item, right? So the best place to classify the income taxes are best classified under the operating activity. You cannot classify income taxes that are paid on in investing, neither can you classify it under the financing, because they do not that particular item do not suit or do not correspond under the investing or the financing activity. So the best place is the operating activity.
All right, could there be any instance, any situation at all that could make you have tax paid under investing activity?
Okay. For now,
Yeah, hold it there. I think let me loop the tax lady into this. Abiodun,
okay.
for the enlightenment of our audience, could you expatiate on what sort of taxes that could be relating to investments, disposal of investments?
Okay, thank you very much, Ko, for that one. So we have taxes that are tax on capital gains, which is called the capital gain tax. So capital gain tax is tax on disposal of capital expenditure. So this type of tax, according to the explanation of Alex, might fit into the investing activities. So it can be classified under investing activities. Are you there? Hello?
Abi, I lost you at a point. My network was failing.
Hello?
Repeat yourself. I lost you at a point. My network was not stable.
Okay, but can you hear me now?
Yeah, I can hear you now.
Okay, so I said we have tax which is imposed on disposal of capital expenditure, and that is the capital gain tax. So this tax, when paid, might fit into, according to Alex's explanation, might fit into the classification of tax paid under investing activities. Can you hear me now?
Okay, so back to Alex. When this sort of tax, capital gain, does occur, where would you report it? Will it still be under operating activity or investing activity? Please, the audience, you are also permitted to make contributions. I believe most people could have experienced this in the course of your practice. Would like you to share your views on this. Alex, we're listening to you. Tayo is here. Tayo is also a very experienced professional colleague. Tayo, would you mind to contributing to this? Tayo Ismaila. Tayo Ismaila, are you there?
Yeah. Hi. So good evening.
Yeah. How are you, sir?
Yeah. So which aspect would you like me to contribute to, please?
Yeah,
I think I missed the last part.
Yeah, so there is a conversation around, could there be any instance where you could have tax being reported under investing activity when preparing cash flow?
Of course, yes. Of course, yes.
All right. So for the benefit of our audience, please throw more light on this.
Yeah. So for income taxes that affect operations, those ones are normally categorized under the operating activities, right? However, like he said, and I think one other person said it, any capital gain on investment such as dividend or any investment that relates to investing activity, maybe sale of asset, and there's a capital gain there, of course, we expect to pay capital gain tax. So such type of taxes would fall under the investing activities. Yes, that's my contribution.
All right, thank you very much. Please take note, everyone. One of the beauty of this kind of session is to address some very unusual issues. I do believe that very many people would not have seen instances where tax as an expense could appear under investing activity. And you could leverage on what Tayo has shared and the insight Abe to share. The very recurring one is where you have taxes relating to your operations. So when you have any component of tax that relates to your basic operation, it should be net. The actual portion paid should be net from the net cash flow from operating activity, right? For you to get the actual net of the operating activity. But where these taxes relate to investing activity, please take note that for appropriate presentation, though rarely occur, but when it does occur, it should be presented under the investing activity. Thank you very much. Alex, I'll come back to you. And I do appreciate the insightful contribution from the two earlier contributors. Thank you very much. Let me quickly come to Abiodun on windfall tax. What does this really mean? There has been a lot of rumor around windfall tax. How appropriate is it? Just in the next 1 minute, give our listeners a brief of what it's all about.
4 minutes. Okay. All right. Thank you very much, Cool, for that. So, the concept of windfall tax came into play in Nigeria sometime around July, when the president requested of the National Assembly to amend the 2023 Finance Act to include imposition of a particular tax we called the windfall tax at the rate of 50%. However, when the National Assembly published the Finance Act, the amended 2023 Finance Act bill, to our surprise, the windfall act rate was increased to 70%. Okay, so what is this windfall tax levy? So this windfall tax levy is come out from a levy, a tax on companies that have earned an unexpectedly large profits during the period. So this tax has actually been conversant abroad, but Nigerian has had no prior history of windfall tax. So in July, this windfall tax came into play in Nigeria. So this is the imposition of 70% on any realized exchange gain earned by bank. So that's in a summary, the windfall tax is an imposition of 70% on the realized exchange gain earned by bank. Would you want me to go further, or that's enough?
Please go further. They need to understand what it is.
Okay, so like I said, the windfall tax is the imposition of 70% on any exchange gain, realized exchange gain earned by banks. So this particular tax has caused a lot of debate in Nigeria since the news came on board, and this is particular because they had mentioned that this tax will be imposed on gain that are being earned in 2023 financial year up to 2025 financial year. And there is a caveat in Nigerian tax law that says that tax must be fair and certain. And to be certain means that ahead, as a taxpayer, you should have known what you are expected to pay as tax. So the imposition of a windfall tax on a period that has already gone, on a past period, does not align with the nature of Nigerian tax law. So another reason why this tax was a debate in Nigeria is because ordinarily, before the imposition of this windfall tax law, FIRS released a circular on treatment of foreign exchange gain for CIT purpose, and it was made specifically.
Yeah, sorry. Before you go into that, I just want a general overview of windfall tax. For the benefit of our audience, I will specifically address those kind of questions so that they will know what windfall tax seeks to address. The concept of windfall tax is not unique to Nigeria, right? There are instances where certain economic variables appears to be more favorable to certain sectors. Whenever it does occur, windfall tax could be raised as excess or additional tax on that sector, right? The federal government considered that because of the fluctuations and various economic policies in recent time in Nigeria, it appears that entities within the banking sector are favored, right? So that policy was then introduced as a way to tax or level additional tax burden on the supposed excess profits that those favored sector must have made, right? Biodun, now back to you. What are the key issues or elements of the account when windfall tax is to be assessed, if at all it is acceptable, right? If it's to be assessed, what are the key variables in the account that windfall tax seeks to relate to?
Okay, so the windfall tax is to relate to just the realized foreign exchange gain earned by banks alone. It's just on the realized foreign exchange gain.
So when you say exchange gain, please enlighten our people better. What gives rise to this? Why do you think the banks are having this favorable advantage?
Okay, so exchange gain is a gain that arises from any company, any businesses that has transacted in a currency not in the home currency. So if you are a business that you've transacted in a currency not in the home currency, for instance, probably you bought or sell in dollars or whatever. So exchange gain arises as exchange difference in general arises as a result of the exchange, the fluctuation in exchange rate per time. So let me take for an instance, let me put a much more illustrative instance to it. Let's say for an instance, I purchase a laptop. Let me say I placed an order for a laptop around July for, let me say, $24, and as at then the price of the laptop is let me say 1,000. The exchange rate of dollar to naira is, let me say, $1,000 to 1,000 naira to $1. So now, let me say this is August. When I purchased the laptop, I actually bought it on credit. That means no monetary value was exchanged for the purpose of the purchase of this laptop. So now in August, I'm making payments for this particular system I bought. But now in August, there could have been fluctuation in exchange rates. Whether the 1,000 naira per dollar is still standing, it could have increased or decreased. So let's take for an instance where the 1,000 naira decreased. Let me say it is now 900 naira per dollar. So that means I've made an exchange gain of 100 naira per dollar. A laptop that I should have bought for 1,000 naira per dollar, and I actually now paid 900 naira per dollar. That's an exchange gain of 1,100 naira per dollar. So the exchange gain is arising as a result of favorable exchange rates. The favorability in the exchange rate has affected my business, so that's what's causing the exchange gain. So now the policy of the government is that.
No, before you get there, I want us to address it step by step, because the concept of realize or unrealize, a lot of people do misinterpret it. So you've been able to establish the fact that when I, as an institution, carry out certain transaction in another currency other than my reporting currency, right? And as at the time the transaction is consummated, if there are differences between the rate at which the transaction was originated and at the reporting date, if the rate is more favorable, it could then be a gain, or otherwise it could be a loss, right? For the better understanding of our audience too, let's also pick an item of an account, say of a balance sheet, say receivable. I sold some quantity of laptop to a customer on credit when dollar to naira is 1,000. So if I had sold to a customer at the rate of when dollar to naira is 1,000 naira to a dollar, right? And that customer is owing me $1,000. That means in my book, I will be carrying 1,000 naira times $1,000, that is 100,000, right? But as at my reporting date, right, the dollar has now lost value, right? If that happens, Biodun, how do you explain that? Is that a gain or a loss?
Okay, so as at your reporting date, the dollar has lost value. Let's say, for instance, let's put a figure to it. Let's say, for instance, the dollar is now 800 naira to $1. So at your reporting date, that is a gain, because something that you should have paid 1,000 naira for, now at your reporting date, you are being reporting that you're actually owing 800 naira as against 1,000 naira. So that's an exchange gain. That's an exchange gain to the company, to the business, being a payable.
In addressing that very well, for the benefit of everybody listening to this, you need to identify in whose book you are operating, right? If you are operating in the books of the receivable, the person that bought the goods, right, it will then, if it is lower than the transaction rate, the exchange rates that you had earlier agreed, right, it will then be favorable to you, right? But to the company that sold the goods expecting to collecting 1,000 times $1,000, right, it will then be a loss. So what the federal government is considering in relation to this windfall tax is that there are components of the financial statement of a bank, right, relating to foreign currency, dollars and every other currencies, right? Policies made by the federal government had made these dollars and every other currency, when they were originally acquired, they were acquired as at the time when the rate was far lower than what it is as at the time those policies were initiated. So it is presumed that banks, other than their day-to-day operating activities, as Alex has earlier explained to us, they had made another set of gain, right? So Biodun, I will now come back to you. Under what instance do we then say this sort of gain is realized, and when do we say this sort of gain is unrealized?
Okay, so I will still make reference to the initial scenario you gave. So in the scenario you gave, it's a payable, and we've been able to establish the fact that it's an exchange gain. So now the next question is it a realized exchange gain or an unrealized exchange gain? So an exchange difference becomes realized when payment or receipt have been made for the revalued sum. What I'm saying in essence is that for the example we gave the other time, that for a business that you are expected to pay 1,000 naira per dollar, but at your reporting date, dollar has lost its value. It's now 800 naira per dollar. So that kind of exchange difference now is an unrealized exchange rate, because you've no monetary value has been received or paid for that particular type of transaction. What you've only done is just to recognize and make provision for the existence of that transaction in your book in line with IFRS. So it becomes realized if you've made the payment. So let's say now that when you now want to make the payment for the said laptop you bought in the following year, you now actually paid that 800 naira. $800 was still 800 naira to $1. That is now a realized exchange gain, because monetary value has been exchanged for that particular revalued sum. So now the concentration of the FIRS is on the realized exchange gain. So realized exchange gain in this sense is being said to mean that the banks have actually realized this profit.
Thank you very much. We are getting there gradually. For the purpose of computing your CIT, your tax computation, can you explain, that is the implication of this windfall tax we are discussing, can you explain to our audience how you would have treated an unrealized exchange gain, right? And how you will have treated a realized exchange gain?
Okay, thank you very much, Go, for that question. Let's take windfall tax into one side and focus on the treatment of realized exchange gain and unrealized exchange gain for the purpose of CIT. Now, CIT is company income tax is one thing, and windfall tax is another thing. So now, for the purpose of CIT, an unrealized exchange gain, it's said to be just a book provisioning. So FIRS have that understanding. So the purpose of CIT, it is classified as a non-taxable income. So if you have an exchange gain in your book and it is classified as an unrealized exchange gain, and FIRS can confirm to the fact that this gain has not been realized, it won't be taxed. It will be treated as a non-taxable income. But if it is realized, then it will come under the caveat of a taxable income. I think we are talking about just gain. So that's majorly treatment of realized and non-realized exchange gain for tax purpose.
All right. So when the federal government is now saying that there will be a windfall tax, remember in Abe's explanation, when you had an unrealized exchange gain or any unrealized gain, most definitely an accountant like Alex will have recognized it as an additional income, right? Meaning it will have formed part of your profit before tax. Yeah. So a tax accountant like Abe will now deduct that amount because it is unrealized. That means in cash, it has not been monetized. As a result, it cannot be taxed, right? Also, on the twin side of that, if you had a realized profit, an accountant like Alex would have also recognized that as an additional income, right? A tax consultant like Abe is expected not to do any additional effort on it because it has already been embedded in the profit before tax, right? A feedback to every accountant in the house that prepares financial statement. That tells you that you will do your company a lot of justice whenever you are reporting exchange gain. Please always break it down. Do specify what portion of that gain is realized and what portion of it is not realized. The benefit of doing that is you will save the company of an avoidable tax, especially where that gain is just a translation or book translation value, which is the unrealized. But when you don't state it, right, you are doing an injustice to the company because a tax consultant like Abe will not be able to decipher it and will have picked a worse scenario, which is subjecting it to tax, right? Now, coming back to the interpretation of what the windfall tax is saying that you will, or they are proposing to subjecting that to tax at the rate of 70%. Remember, we are concentrating on the realized portion. Now, that realized portion, which has already been embedded in your CIT computation, invariably, if that company most likely is a large company, is exposed to any CIT will have been computed at 30%. Abe, given that this particular line item that gave rise to the conversation around that windfall tax, do you then think that in spite of having subjected that amount to tax at 30%, is these policies now saying that you now still pick that amount and subject it to tax at 70%? What's your understanding of it?
Thank you very much, Co, for that. Okay, before I answer that question, I also want to address the issue of the subjection of realized exchange gain to tax for CIT. You know, you made mention that an accountant would have already classified an exchange gain as it would have been added to what's it called, the income of the company, and as a result of that is already embedded in the profit of the company. One of the concern the circular FIRS released sometime around, I think, June or so, is to stress the fact that when an exchange gain is reported in the OCI, that's the other comprehensive income, it will still suffer tax. So in a situation whereby an accountant is disclosing the exchange gain, let me say the realized exchange gain now in this OCI, and that has not been added to the profit before tax, a consultant like me will add it back as an additional profit that was incurred for that period, and it will be taxed. So now, answering the question of how the treatment of the windfall tax levy, that is actually one of the debates we are having presently in the tax world of Nigeria, as to there is going to be a double taxation if the government is saying that an exchange gain that has already suffered its CIT tax rate at the rate of either 20% or 30%, and you are still subjecting this same income line item to a windfall tax at 70%. That's already double taxation. So right now in the tax world of Nigeria, we are not still sure of how the government is going to propose the treatment of this windfall tax. There is actually two scenarios to this. Either the government will say, okay, because the windfall tax is at 70%, and because this particular profit line item has already suffered CIT at 30%, whether the CIT that has been suffered already will be taken as an offset against the windfall tax to avoid double taxation, or whether the government is saying, regardless of the fact that this particular income has suffered income tax, is still expected to suffer windfall tax. The law is actually not clear on that, and because it has not been passed as an act, we don't know what to expect.
I'd like to throw it to the audience. Is there anyone who has any view around, especially the application of this windfall tax, on what we have been discussing, that would like to share with the entire house? Anyone? Ty, I would still like to come back to you. Do you have anything you want to share on this? Is Ty there? Okay, so while we are waiting for the contribution of others to this, my personal opinion as regards this is the intention for tax is not punitive. It's not to punish any taxpayer, right? And it is also it also has this unique feature of being fair. My opinion, and what I've also seen other countries do, is that if that line item had already suffered a tax or tax at certain rate, right? What will then be done is, what is the rate of the windfall tax rate? Compare it with what has already been suffered before. It is now the differential that will be levied on that very line item to ascertain what additional tax you accrue as payable to the government per time. But we are expecting clarity on that, especially how the government wants to implement that intention. We look forward to getting clarity on that as soon as it is made available. And when it is made available, of course, we come back to you. I will have a roundtable talk around it again. Abby, thank you very much for your insightful contribution. Permit me to quickly go to our audit practice now. Kazim, are you there?
Yes, please, I'm here.
All right. Kazim is my colleague in tax practice, and he will be speaking on his 220 today. Within the next 2.5 minutes, can you enlighten our audience on what his 220 is? How is it different from the previous topic we had earlier considered, ISQM 1 and that of ISQM 2?
Okay, thank you so much. So we are looking at quality management for an audit of financial statements, which is ISA 220, International Standard on Auditing 220. So broadly speaking, this particular ISA covers two areas, which is the scope of the ISA. The first one is the firm's system of quality management and the role of engagement teams. So as we all know, just like every organization, we usually have the system and the system in which the team rather in which the in which operates around the system. So for the firm of accounting or auditing as well, in carrying out audit of financial statements, we also have a system and we have a team. So on that basis, in addition to these two scope, we are also to discuss about relevant requirements of the standard in relation to quality management for an audit of financial statements. So we want to look at the firm's system of quality management first, which talks about the system itself, the policies, the procedures, and the foundational to the integrity of audit firm. So under the international standard on quality control, which is IAS one that Code made mention just now, the firm has the responsibility to establish and maintain a system of quality control, which simply means that the firm itself is saddled with the responsibility of the establishment of system of quality control. So we saying quality control, what do we actually mean by quality control? In general, quality control is all about ensuring that service being delivered is of high quality. That is, there is a process around it, process are duly followed, and everything happen within the process. So that's what quality control is talking about. But in relation with audit of financial statements, we are talking about quality control in terms of how the audit is being, carried out, starting from the planning of the audit to the execution and then finalization. So how do we plan the audit in accordance with other ISA such as ISA ISA 200 and all other relevant ISA as well, and is the audit being executed in accordance with the relevant ISA at each stage? This is what this is trying to address. So in spite of this, we have the system actually aim to provide reasonable assurance in two ways. We can look at it from two ways, which is in terms of compliance and in terms of appropriateness. So when we talk about compliance, we are talking about the engagement team and all other personnel in the firm that engage in the audit of financial statements. They adhere to all the professional standards and including legal requirements. We all know that what is guiding us in this practice, in audits and accounting practice, is either we're following standard or we're following regulation in terms of, say, local regulations, right? So those two things has to be followed when we're talking about compliance. So we made mention of compliance and appropriateness. So in spite of appropriateness of the report, simply means that the reports that will be issued at the end of the financial statement in relation to the audit has to be appropriate in a given circumstance. So in a given circumstance simply means that we give a report a true and fair view. An auditor usually issued an opinion at the end of audit engagement. So we're saying now that at the end of audit engagement, we need to issue an appropriate report given the evidence that we've gathered so far through the course of the audit. So this is what it's trying to address. So in summary, we can base this is at 220 on the premise that the firm is subjected to ISQ C1, which is all the national requirements which we made mentioned earlier. So now we said the scope of this ISA is divided into two. in the earlier conversation. We said the firm's system of quality management and the role of the engagement team. So let's talk about the role of the engagement team in this regard. So within the context of the firm's quality control system, engagement teams have a crucial role, no doubt, in implementing the quality control process. The engagement team, the system cannot work without the engagement team. So who are those to carry out what the system has already put in place in terms of quality control at the engagement team? So this engagement team are responsible for the firm's information that enable the functioning of the firm's quality control system. So basically, they are also saddled with responsibility of abiding to the code of conduct by ICANN in the case of Nigeria, and also International Ethics Standard Board for Accounting, which is IAS. So just to round that up, the engagement team can rely on the firm's quality control system unless information provided by the firm or other parties suggest otherwise. So it simply means that in as much as the firm quality control system is abiding to the relevant standards and law, the engagement team is saddled with that responsibility of abiding to it. So lastly, we have some requirements of this standard in establishing quality control management. There are many of them, but let's look at we have leadership responsibility for quality control and audit.
Hold on first. Thank you for having been able to establish the fact that ISA 220 is looking at what an organization is expected to have in place on each or individual audit engagement, while ISQM 1 is actually looking at the firm or the whole system as a whole. Whether you are doing audit or you are not doing audit, what are the structures you should have in there? Right. Given that you are an experienced auditor and you are to checking the quality control system that relates to ISA 220 on a particular engagement, right? What are the key things you will expect to check or verify in line with ISA 220?
Yes, sorry please, I lost you at some points. My network.
Okay, I'll take that again. I said you've been able to establish the fact that ISA 220 addresses what quality control should be on every individual audit engagements. As far as the ISA 220 is concerned, it's not looking at the entire firm, it's looking at what quality measures has been initiated when you put an audit plan for a particular audit engagement, right? While ISQM 1 concentrates much more on what structure as a system an audit firm is expected to have, whether you are doing an audit or you are not doing an audit. As long as you've been identified as a professional firm, right, the entire structures that you should have is what ISQM 1 establishes. I now said that since the topic of conversation today is on ISA 220, you being an experienced auditor, so checking quality measures on a particular audit engagement for a client, right? What are the things you will be on the lookout for?
Okay, yeah. Can you hear me please first?
Absolutely well.
Okay, so quality control in relation to audit engagement is what he's trying to ask, right? So
Yeah.
like I mentioned earlier, the quality control in line with ISA 220 is linked with relevant ethical requirements as well, such as independence of the auditor. So when we talk about independence of the auditor, we know that this is coming from ICANN Code of Conduct and ISBA Code of Conduct, which states that the auditor should be independent of the firm, right, or the company that they are auditing, in order not to breach the threat of familiarities and its likes, right? So independency is one, which is part of the requirements, right? So also we have assignment of engagement teams. So part of the quality control that should be in place is that the engagement teams, right, member of the engagement team rather, that will be attached to that very assignment must have competency. That is, they must have the ability, vast knowledge of the industry in which the clients operate, and also they must be knowledgeable about relevant accounting standard and regulation within that system. Because what we do as an auditor, we bank much more on our knowledge of all these standards and regulation. So as well, that's what we're trying to do, to evaluate the client's entire system, including their financial reporting and internal control. So assignment of engagement team is very crucial and important in setting quality control in place. So as part of the quality control as well, we have what we call review. Quality control, we have to have review of the whole process. That is, review can be in many stages, can be in various stages. We could have a peer review, whereby the work done by an engagement team, would be reviewed by another person, just to ensure that appropriate procedures and I would just just to ensure accuracy and its likes on that part. So we have other forms of review as well, such as code review and its likes. So review is also crucial when you're trying to maintain quality control management within the within the engagements. So also part of what we have here is monitoring. We have monitoring in terms of monitoring the process of the audit at every stage. This generally in practice could be done by the supervisor or the engagement partner, to ensure that the auditing and in right direction in terms of carrying out their assignments, and they are not too far from what is expected. So those are the few quality control measures that could be put in place in the audit of financial statements. I don't know if you have any addition.
Absolutely fine. Thank you very much. So I believe our audience has listened to this. If you work in an audit firm, there is a saying that says perfection is a work in progress. You might not be there yet, but you have to consistently make efforts to ensure that each and every of your process is growing by the day towards ensuring that it aligns with what the provision of the standard says. So as far as ISA 220 is concerned, there must be certain quality measures implemented, right, to ensuring that the output of that audit will be as independent and reliable as possible. And some of the things that COSIM has identified is the fact that before you even take the engagement at all, have you assess your risk? So you, as the audit quality assessor, we want to check what is the familiarity of the engagement partner with the client. Is there anything between them that could not make the report of the audit as unbiased as it is expected to be, right? What checks has been implemented to be double sure that the report that the organization is even preparing for you or presenting for you to audit has been prepared by people who has a requisite experience, who has a requisite competence, right? Quality control in that organization that will attest to the reliability of the information used in preparing that statement could also be assessed. Then you also look at how competent is even the audit team. Do they have the requisite support? Do they have the requisite training, hands-on experience in being able to handle that sort of audit engagement, right? So you look at the planning that has been done, you look at the experience, you look at how will the reports be reviewed, such that you'll be sure that the reports that they are or the firm is giving is as authentic or unbiased as it's expected to be. So I will encourage everyone operating within that space to still go through the standard itself, review and see values that you need to draw from there to improving your internal process. And I do believe this will be beneficial as possible. Please, if you have any question at this point on what we have discussed thus far, feel free to ask in. For the benefit of those who have just joined us, this talk show is the social contribution path of the firm KCP. KCP is a firm of chartered accountants. We offer audit services, tax services, accounting services, some HR support services, and training, as well as regulatory services. We are very much open and concerned with the advancement of the accounting profession, and that is why we feel that from time to time we should make contributions and positive influence on co-accountants and new entrants into the practice, such that we will together do the practice proud. So please feel free to ask any questions that may concern you, that may interest you. And even beyond the conversation on this platform, our firm is very open to collaborating with any other firm that may need or want our professional contributions on any engagements they might need additional hands on, right? And on an individual basis, for those who are having challenge in the course of their day-to-day work, please feel free, and you need a second opinion, feel free to engage any member of the team through the mentorship group, share your views, present your questions, and I do believe those questions would be addressed at no fee. We are not charging any fee for doing that. All our concern is let everything we do as an accountant be as correct as it should and as reliable opinion as we ought to give out. If there is no question at this moment, we quickly want to address the last part of the session we have for today, which will be anchored by Matilda. Matilda, are you still there?
Yes, yeah.
All right, so can you quickly engage the audience on what we mean by the evolution of performance management?
Okay, good evening, everyone. I'll be taking you on the journey of evolution of performance management. And I'll start by bringing to you what performance management is an evaluation method for staff performance that affects the profitability of the company. So, the evolution of performance management primarily relied on annual reviews, where managers and employees would assess performance, set goals, and discuss career progression once a year. However, this approach has become inadequate in today's fast-paced, diverse work environment. Annual reviews are limited because they focus on past performance rather than ongoing developments, which can lead to delayed feedback and missed opportunity for timely improvements. So as a result of this, there's a shift towards continuous and flexible performance management method that better meets the needs of modern organizations and their employees. So, the limitations of annual reviews. In addition,
before we get there, can you dwell much more on why you think performance management is relevant and how it should be done?
Okay, so I think performance management is relevant because it enhances easy tracking and feedbacks. Some people have, like in some organization, they can have performance app where your details as an employee is logged in by the HR. Then the team leads will also have access to the app. They score you on the app, and the overall, like co is our overall head, will also score you. Then at the end of this, there's a column for feedbacks on what to improve on to make the next performance review better. So the employees can also get feedbacks. Through their email. So the employee take these feedbacks, act on it, and they score higher on the next performance evaluation. So I don't know if I answered your question, sir.
Yeah, absolutely well. But there is a part where you said earlier in your statement that performance management is historical. How do you think it can be futuristic?
Okay, I think it helps to promote and change future events, like whereby the employees get feedback on what they've done before in the past, and then they are able to correct their mistakes in the next performance evaluation.
So what is the best approach, in your own opinion, what is the best approach to actually implementing this?
Okay, so for me, I think annually would not work for performance evaluation. Monthly evaluation would be better so that employees can know that I've made mistake in the past month and I need to correct myself and become more better in my job. And instead of waiting for 1 year to go about it.
How best do you think performance feedback should be given in such a way that it won't affect the emotional ego of the staff? Let me explain that better. There has been instances where performance appraisal is being done, right? And the feedback is being communicated to the staff's concern, or rather than the staff looking at it objectively, it affected their emotional well-being, right? How do you think feedback, especially where it is not too favorable, should be communicated in such a way that it will not affect the emotional well-being of the staff? Or what do you think should be the attitude of staff to performance appraisal feedback?
Looking forward to it.
Okay, I think staff should look forward to their performance review, whereby I just think they need to just.
Okay, what I'm trying to say in there, and this for the benefit of everyone, whether we like it or not, life even appraises us, and that's why some people say today is a product of our yesterday. And our tomorrow is also influenced or will be determined by what we do today. So from time to time, feedback, where you work in a system where feedback is given, you need to accept and approach that process with an open mindset, right? There are instances whereby the feedback may not be honest in some organization, may be biased, right? But whatsoever feedback that has been given to you in the course of your work, a good system will allow you or should allow you to also respond to the so-called feedback that is being given to you. You should have a chance to be able to say, okay, this particular thing, if it's truly not as it has been communicated, you should have constructive and evidential premise on which you can then say, oh, this particular allegation you are giving about my below performance in this area in a very expected manner, this is what happens at that period. This is the expectations that was given to me. This is the milestone that I've covered, right? And you should be able to defend yourself if you think, right, you have done the right thing. But if the feedback that has been given to you actually depicts that you act below that very standard, right? And if it is honest, try as much as possible as staff to be open-minded enough to accepting those feedback, and possibly if you are not too clear on what you could do to improving your performance subsequently, ask for help. And that will lead me to the next question. What are the measures that organizations should put in place to help staff or the appraisee improve on their identified weakness and even strengths?
So I think, can you hear me, sir?
Yeah, very well, sir. Very well, ma'am.
Okay, so I think a constant feedback will bring about a positive impact on the company's performance on the employee, whereby if the employee gets a feedback that is too frequent, a feedback that is too frequent will wear the staff down, most especially if it is a negative or unfavorable feedback. So if the employee gets feedback all the time, the employee will know what to do and what not to do. So instead of doing annual performance evaluation, it is good for them to do like a monthly performance evaluation, so that the employee is aware of the past mistake he did in the previous month, and he or she will be able to correct his or herself.
All right, thank you very much. Thank you very much. It has been an engaging section. In the last 1 hour plus, we've been having conversation around in accounting, that is financial reporting. We considered IAS 7, where we discussed the fact that accounting standards regulate how accountants should prepare financial statements. One of the cogent statements that should be prepared in every financial report is said to be the statement of cash flow. And we've been able to buttress the fact that process to preparing this, how it should be prepared, information to be contained therein is as guided by IAS 7. One of the cogent areas that we address there is to bring out the fact that in every statement of cash flow, there are 3 components, which we call 3 activities, right? The first was identified as the operating activity. The second was identified as the investing activity. And the third was identified as the financing activity. In Alex's words, Alex did emphasize that for you to identify the items to be in operating activity, you need to understand what was the company actually set up to doing. So your primary assignment, right, if it's a trading company, the inflows and the outflows from the trading will eventually be reported in the operating activity, right? Assets acquired and investment made in other companies will form what we have in the investing activity, right? And funds that is generated to facilitate the day-to-day operation of the company will be reported under the financing activity. We're also able to identify that when cash is received from any of these or through any of these activities, it is identified as a cash inflow. And when cash is expended through any of these activities, it is said to be cash outflow, right? Then we also were able to establish the fact that according to the standard, two distinct methods was identified by the standard as a way through which cash flow or statement of cash flow should be prepared. We did have direct method and we have the indirect method. The direct method is that which has been recognized or supported by the standard, and the indirect method helps in reconciling the accounting profit to actual cash profit. It is very unfortunate that even though the standard recommended that we use the direct method, it is found out in practice that most reports that is being prepared, the indirect method is used. That would be a question to bother on, or a mystery to bother on to dwell on or think about by everyone. Why do you think, in spite of the recommendation of the standard, most accountants in practice, or most accountants in practice, or auditors, still issue out reports and never comment contrarily about the usage of the indirect method in preparing this statement of cash flow, right? We did identify some intriguing items like interest and dividends, because these have a dual nature. Interest could be interest received and interest paid out, and it could dividend could also be received and paid out. So we identify how this should be presented on the face of the statement of cash flow. After that, we considered windfall tax, right? And Audit talked about that as the excess amount of tax that accrues on the identified taxpayer by reason of the favorable disposition to that very sector arising from national economic policies. And we explained some intriguing aspect of that too. Then Cousin joined us in explaining dissecting ISA 220 and related that to ISQM 1 and 2. And finally, Matilda discussed about the evolution of performance. Any questions from any quarter on various things that we have discussed thus far? We'd like to address these questions at this time.
Good evening, everyone.
Good evening, Oluwaseyi.
Okay, good evening, sir. It's a pleasure to be on this meeting. Okay, so I would like to ask about the fact that Matilda mentioned about performance management. So I have few questions I would like to, for you to shed more light to that I might be interested to know about. Okay, so I want to understand how do I handle underperformance within a team, and then is there a way that you can walk me through a process for addressing and improving it? And that's my question. Thank you.
Okay, let me address that. Underperformance in the team, how can it be handled, if I get you right?
Yes.
In my personal opinion, I do believe that there is no dullard in anyone. So one of the first ways you can address that is to actually understand your team. Understand your team very well, know the mood of your team, know things that other than monetary reward, know things that could actually intrigue them to performing better, know things that could demotivate them. So one of the best way to address that is what factor. It has been established that they have underperformed. What factor is actually responsible for that underperformance? Is it attributable to their personal inefficiency or factors beyond their personal efficiency? If you are then able to establish that it is as a result of their personal inefficiency, then recommending them for training may be suitable. If it is identified that it is due to factors beyond or in spite of their prowess, their intelligence, their competence on the job, they are still underperforming, you may then identify what factor actually responsible for that. For example, in the past, I've had instances where I led a team. The lady is an excellent performer, but over a defined period of time, I noticed that even when you give her instructions to do, before she set out on the instruction, set out from you to carrying out the instruction, she has forgotten all that you have told her. How do you address that? So initially, one could just conclude that, oh, she's been absent-minded. So what I did in that instance is to call her one-on-one and talk to her what actually happened. I was able to know that that is not her nature because I knew my team. I know her to be somebody who delivers well on the job. So you cannot appraise someone, a member of your team, if you don't understand the strengths and weakness of that very person. So that should be the starting point. So by and large, the result of that was that I was able to identify that beyond work, in spite of whether the pay is good, the pay is not good, there are certain factors personal to her that is eating her up, right? So if you find out that that is the situation, sometimes you yourself may even need to seek for help, how best to addressing some of those situations. If it's something that she needs a time off work, he or she needs a time off work, see how best you can keep the work going while that person can take time off to put herself together. If it's something that needs to get to a professional counselor, check within the organization if you have any policy or budget that will address that. So those are some of the issues, process that you could follow to addressing underperformance. If after you have done all of that, the person is still not improving or is not looking like situations could change, then at that point the organization may then have to look into their policy and take a decision as regards that. Is that okay, Oluwaseyi?
Thank you so much. Well noted.
Yeah. All right. I still look forward to questions from every other person. Please, when we are coming to a session like this, try as much as possible, especially questions relating to the topics that we are discussing. Bring as many as possible so that we can learn from each other. That is the only way we can do ourselves good and also rub our intelligence on others too, as well as our experience. Any other question, please? Any question from any other person? The Task Club UI, any questions from your side? Any question?
Good evening, sir, and good evening, everyone.
Good evening, Ma.
Okay, so you mentioned
Introduce yourself first, Ma.
Okay, sorry, I'm Bukola. My name is Bukola.
Bukola
from, I don't know, nobody introduced themselves from where they are actually
Okay, no
communicating.
problem. Go ahead.
Okay,
It's good.
okay, thank you. So you mentioned the direct and the indirect. I know we're talking about cash flow, statement of cash flow, which is IAS 7. So you mentioned direct method and indirect method. So you were trying to explain further, but at some point, I don't know, maybe you gave room for questioning. So I need you to just buttress a little bit on that direct method, that even our auditors and some financial analysts don't use the normal standard, so they still use the indirect method. So I just need more light to be shed on that, sir.
Okay, yes, I actually intentionally paused on that because I wanted everyone to share their views. Good that you have made mention of it, so I can pour out my opinion on that. It is true that the standard recommended a direct method, right? And but unfortunately, auditors and preparers of the financial statements do report contrary to the provisions of that very standard. Why? The reason is this, and I'd like to give you a practical example about that. There was a company at the very earlier part of my career that I worked with. I was the reporting accountant in that organization then. So in a particular year, we prepared the financial statement and we identified, that was around 2007, 2008, we reported an accounting profit of about 100 million or thereabouts then. So my MD, being a lady, she was very happy that, the year has been very productive. We have, as a startup company, in our second year thereabouts, we had 100 million worth of profit. So she quickly dashed to the bank account to check in the money. How much do we have? Our expectation is that if we had made an accounting profit of 100 million, we should be able to see the 100 million in our bank account. Unfortunately, by the time we checked the bank accounts as at that period, we had a sum of 50,000 there. What happens? So she was annoyed that how could we say we have made a profit of 100 million and we could not see the 100 million in the bank account? Where then is the money? There comes the need for statements of cash flow, right? So cash flow actually helps you to identify, right, your cash at the beginning of the period, what you have generated during the period, the various things you have used or expended the money on, and what you end the year with in cash. So if you look at the component of the direct method, then it could not address that kind of situation, because not just for in the case with that of my former boss, but many other non-accountants find it very unbelievable that huge amount of value has been identified or reported as accounting profits, and contrary to that, we have something else in physical cash. So indirect method help us to answer that sort of question. It helps you to reconciling what you have as your accounting profit, and that is why the operating activity in indirect method starts with what is your net profit before tax, right? And work through that to what are the non-cash transactions that you have actually adjusted on that net profit. I mean, you have actually adjusted on your profit, even at the net profit, right? So it helps you to adjust if you have some non-cash expenses. It helps you to add it back, because if it is non-cash, it means in reality we did not spend it. And it also helps you to adjust some non-cash profits. So if there are items that you have recognized as profit, but in reality is not creating cash for us, let's take it out of it. So the end product of that particular sequence of process helps you to reconciling what your actual cash profit is to what your accounting profit is. So auditors in practice, accountants in practice uses that method because they want to save themselves of the need to explain this to everybody, but presenting a statement that can reconcile this discrepancy and tell you that your real cash profit for the year is your net cash inflow or net cash outflow from your operating activity. Bukola, I hope that answers your question.
Yes, thank you very much. Yes, please.
All right. Any other question from anyone? Any other question from anyone? So please try as much as possible to tell your friends and colleagues that you think will have a need of this kind of talk shop. Our regular time every month is last Thursday of the month, 6 o'clock. We kick off. In the course of the month, we will have shared various content. We expect that you relate with those contents, reconcile that with your work, what aspect of your work is related to that content we are discussing for the month that you need to come here with to ask, or you can even engage us before then, right? And we can assure you that all your queries or requests will be addressed. If there is anyone that is not on the WhatsApp group, the mentorship WhatsApp group, please indicate. Oluwagogo, please share the number of the WhatsApp. Get their numbers for those who are not on the group so that you can add them to the group. We have most of those conversations on that group. Otherwise, you can also engage us via our various social media and especially the LinkedIn. And I do believe all your queries will be addressed. So in the absence of any question, I will like each of the speakers to give their last final words so that we can wrap up this session. Starting with Alex.
All right. Thank you very much, Cole, for the clarity on all the subject. So my closing remark here is as an accountant or as an investor, shareholder, most of the time, we're always bothered about the SFP and the statement of profit or loss. So most times, people always neglect the statement of cash flow, which is not adequate, which is not proper. So my candid advice is that in the course of you doing your analysis, always try and look at the statement of cash flow because it explains clearly or in overall summary what the business has actually done with their available funds. And always look at the overall balance. Are they running at a surplus or are they running at a deficit? And you can also consider to check the SFP, the cash and cash equivalent, the balances that you have on the statement of financial position under the cash and cash. Do they align with the closing balances of the statement of cash flow? So should in case it doesn't align, then you know that there's a problem with the computation of the statement of cash flow, and you then need to flag it up to any respected preparers of the account or to the company. Then in all, cash is king. How you manage it will show at the end of the year. Thank you very much.
All right, Alex, thank you very much. Cash is king. You have to manage it profitably. Thank you very much. Abby, over to you, ma.
All right, thank you very much, Ko, for that. So my final word there is going to be that even if you are not, you don't have a company in the banking industry, it's still necessary for you to be awakened about regulations and about tax regulation or any levy in Nigeria, because the Windfall Tax Act has not been signed. So there is still possibility that it might still span through other industry aside banking sector. So as a company owner or accountant in different parts of industry, it's necessary for us to be awakened and abreast about how regulations in Nigeria can affect our day-to-day transaction. Thank you.
Yeah, you need to be aware of the laws, the regulation from time to time. It doesn't matter whether the policies now directly affect what you do or where you work, but as an accountant that has tax practice competence, you should be able to make meaningful contributions because you don't know where those insights will be required. Thank you, Abiodun. Cousin, over to you, sir.
Thank you so much for listening, everyone, and thank you, Ko, also.
All right, thank you very much, cousin. Thank you for all that you have shared in the course of this presentation. And the last, not the least, of course, is Matilda.
Thank you very much, sir. So my conclusion here is the evolution of performance management from annual review to continuous feedbacks and goal setting reflects a broader shift in how organizations approach employees development. So the ability to provide timely, relevant feedback and adapt goal to current circumstances is critical. So by embracing this new method, companies can better support their employees, improve engagement, and achieve sustained success in an increasingly competitive marketplace.
All right, thank you, Matilda. And to everyone who make time out to attend this section today, we want to express our sincere gratitude to you. To those who also ask questions and make contribution in the course of the session, we appreciate you. Please do us proud, do the accounting practice proud, be the best at what you do, and let's also share this good news to as many as possible within our network that you think should be here and could also learn and better their practice. Till we see again, same time next month, we pray that the Almighty God will preserve us even beyond the time, and in all of our endeavors, we will do great exploits. See you next time. Good night. Enjoy your weekend.
Thank you so much. Bye.
Yeah, thank you.